I'm Yanely, also known as Miss Be Helpful, with another FinCap Friday brought to you by NGPF. In early 2023, Silicon Valley Bank collapsed. It was the 16th largest bank in the US, so that's why it was such a big deal. In order to understand what happened with Silicon Valley Bank, first you need to understand how banking works in general. Banks are for-profit institutions, which means that their goal is to make a profit. When you deposit your money in a savings account at the bank, they don't keep all your money there. They only put a small amount of it in reserves based on the minimum that they're required to have on hand. That's determined by the Federal Reserve, and that's normally about 10% of all deposits. But what does the bank do with the other 90% of deposits? Well, banks can either lend it out to other customers at a higher interest rate than what they offer you, or they can buy investments that they think will grow in value. But don't worry, your money is insured up to $250,000 per depositor per bank. This protection is called FDIC insurance. If the bank loses your money, then the FDIC will make sure that you get your money back. Okay, let's get back to Silicon Valley Bank. They lent out some of their deposits and then they made investments with the rest. Bond investments. Bonds are different from stocks because they're not as risky, but they can still change in price the way stocks do. It's just that it happens less often. From 2020 to 2022, startups were adding more and more deposits to their accounts at Silicon Valley Bank because they were raising a lot of money from investors. But as inflation started to increase and interest rates began to increase as well, investor money dried up. That's why in early 2023, depositors began to take more and more money out of their accounts at Silicon Valley Bank. They needed to use that money to cover their company's bills and to pay their workers. That's when the bank got nervous because they didn't have enough cash to be able to handle so many withdrawals. So they decided to sell those bond investments that they had purchased a few years prior. That way they could get some cash for them. But the problem is those bonds they invested in had lost value and dropped in price. So instead of buying low and selling high, like most investors say you should do, Silicon Valley Bank ended up buying high and selling low. And that's not a good look. They lost a lot of money. So they decided to try to raise money desperately, and word got around, especially on Twitter, and that's when all their customers began to panic and try to withdraw all the money that they could as quickly as they could. And that's called a bank run, and it's not fun for bankers. On March 9th, 2023, depositors tried to withdraw $42 billion from Silicon Valley Bank, but the bank only had $41 billion. Not having enough money to help all of the depositors access their funds, the FDIC had to step in and take over the bank. So what can everyday people learn from this situation? First of all, make sure that you only do business with financial institutions that are insured. For example, banks that are FDIC insured or credit unions that are NCUA insured. As more and more people start to get comfortable using fintech apps on their phone, it's increasingly likely that the cash you have sitting on your mobile device is not protected. At the very least, do some research. Finally, don't panic. When everybody tries to withdraw all their money from the bank at the same time, it just creates more panic, more fear, and more chaos. Fear begins to mess with our psychology, but it also messes with the financial system. Banking was designed to allow for banks to be able to lend out some of their deposits, so we can't freak out every time scandalous headlines are printed. We have to find out exactly what's going on and make a calm and informed decision about what to do with our money.